Welcome to our weekly investment update. It's Friday the 22nd of May. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. And as we do on these weekly videos, it's nice just to look back over the past few trading sessions and perhaps pull out some of the salient points which have been driving markets over that time period. So as we look back, it's kind of what we've been talking about. A lot of this really negative, tremendously bad economic data is now coming out, and we've seen that in everything from manufacturing surveys to service sector surveys. UK, of course, came out earlier on this morning with its UK retail sales, and it was down minus 18%. We've continued to see this climb in initial jobless claims in the US, although I would say that it's nice to see that slowing trajectory. It's still got an awful long way to get back to normal, but if we were going back 4 or 5 weeks ago now, we were up at 6 million initial jobless claims a week, and we're now down into the 2 and 3 million figures. And so that's slowing, and I think we're starting to see some mobility of people come back online, although the caveat is it's from a very low place. In other economic data, of course, we're seeing governments come out with very large budget deficits. In fact, UK came out with a monthly budget deficit of £62.1 billion in sterling. It's the biggest monthly budget deficit that's on record for the UK, that goes back to 1993, and far bigger even than the monthly budget deficit that we saw in the Great Financial Crisis, which stood at around 22 billion for the month. So these are very big numbers, but we're fully expecting them. I think markets are fully expecting them, simply because these are the direct result of policy action, which, as we've said, I think in every video that we put together, is the direct result of governments suppressing social and economic activity to try and flatten the curve or suppress the growth of coronavirus. So how have markets reacted to all of this? Well, actually, the start of the week, if we looked at equity markets first, the start of the week was very positive. We saw some positive momentum in markets. This was really centered on a lot of the European economies reopening. We saw a lot of the US states starting to reopen. Oil price recovered rapidly and has continued to do so through the week, really as both we see further supply cuts, but also the demand side starting to pick up. And this was really the big point that we were talking about a month ago when we saw West Texas Intermediary, WTI, fall to negative territory for the very first time. Really is demand for oil just absolutely collapsed, and we've seen that come back. It's nowhere near what it was pre-coronavirus. We are still in the very early stages of reopening economies, but those green shoots are starting to come through in a lot of parts of the world. So equity markets were very positive at the start. We saw some big moves up on both Monday and Tuesday in the week, and actually some markets set some weekly highs as we went into Wednesday. And then really what's kind of been now pressing on markets since that point has been the growing political tensions and maybe some fears around supply chains which extend globally, and really this is centered, of course, on the rhetoric between US and China, which is escalating far beyond trade wars, which is what we've been kind of discussing for many months, but also now going into both the cause of the virus, which is very much part of Trump's daily rhetoric, on certainly if you look to his Twitter account. And part of this will be, of course, we're now getting into US election season. Trump doesn't want the blame to be brought to him for handling the coronavirus, and therefore if you can pass that on to somebody else, whether these are factually true or not, it certainly makes you appear better in the election polls. The other thing going on, of course, which might lead to even greater tensions between the two, is some of the policy moves over Hong Kong. Of course, we know that Hong Kong was passed back after a lease period to Britain in 1997, and there was supposed to be this 50-year period where Hong Kong would continue to have legal independency and free markets. And really the protests we saw in June 2019 were centred around some of this independency of legal freedoms being eroded, and vast amounts of the population, nearly 2 million Hong Kong people came out onto the streets, and for a city-state with only 7.4 million, it's a huge amount of population. So these things have been going on in the background. It has lent itself in the back end of the week to a little bit more of a risk-off mood. We've seen government bonds around the world, their yields decrease, which is showing some inflows, and this is really kind of backed up by some of the surveys that we look at for sentiment as well, such as released yesterday by the American Association of Individual Investors. They look at, well, how many people are bullish in this time and how many people are bearish. And so these things have assisted the uptick of government bonds in that space as well. Actually, we've seen some landmark points in the week. So the US, for the first time since 1986, launched its 20-year bond, and this was very well received in the marketplace. And it's really just the case of the US trying to push some of that debt that it's having to raise to fund its budget deficit, pushing that maturity down the road a little bit. Up until now, it's focused very much on issuing shorter-term debt, which has been the most in demand in the marketplace, and so this has been a kind of a good development. In other places, UK government, of course, for the very first time issued a government gilt with a negative yield. Now, it wasn't vastly negative. You have to go a few decimal places to even find the number, but it is a significant turning point. It's the very first time in history that the UK has done this, and it does kind of pave the way should Bank of England wish to implement some less traditional tools and potentially use negative interest rates, although they have said up until now that they don't think that's needed, or it's not something that they are thinking about. This does pave the way, certainly, of what the markets think might be coming up. So these are all very interesting turning points in markets. Hopefully we will see the positive end to the week, even though we have seen these few sale days kind of at the tail end. Hopefully the very buoyant enthusiasm that brought us into the week will allow us to end Friday's trading around the world on positive territory. If we looked at other places, then we continue to see crude oil having a good week. Again, this playing back into just simply the use of it and the opening up of economies. And those things are continuing. We're continuing, if you look to more what we would call high frequency data. This is not the data which is lagged by kind of government surveys and data points, which can be several weeks out of date by the time we get it. But if we look to kind of the mobility data and things like that, people are moving around an awful lot more. And these are the green shoots, really, of getting an economy back on track and really starting to make some progress. Are we completely out of the water? I don't think we are. I think the level of both central banking measures, monetary policy, as well as fiscal policy will have its reckoning. We are seeing some signs in certain sectors of market distortion. We talked about this in a earlier video about some of the airlines almost becoming nationalised, and this is happening in different pockets by some of the tools which are being used. So I think there are some potential headwinds up ahead, but it's a promising sign to see economies starting to come back to some sense of activity and to really start planning that future ride up ahead. So from all of us at Dragon, I think that probably wraps up what we've seen going on in the markets. So for all of us here, I wish you a very healthy and happy weekend. Please enjoy your Monday bank holiday here in the UK. Global markets will be open and we'll be keeping an eye on those, but we'll see you for another market update at the end of next week.